Hello fellow traders. Today we'll explore real-world performance on various option strategies using SPY as our case study. We'll connect the market context, options analytics, and actual trade setups to reveal what works and why. Today we're going to get into option strategy performance, historical backtesting results revealed by a pajama trader. Give this a like and subscribe. Let's get into it. Why backtest option strategies? Backtesting helps you simulate a strategy's results using historical data. This process reveals win rates, average returns, drawdowns, and risk before you ever risk real money. By understanding how a strategy would have performed in the past, you can approach live trading with greater confidence and discipline. Think of backtesting as your trading flight simulator. It's where you learn, experiment, and build confidence without financial risk. Market context. SPY's recent price action. SPY reached an all-time high of 611.39 before plunging to 481.80. A rapid recovery followed, taking SPY back to 586.95. with resistance at 595 and support zones at 567.50 and 577.04 and 529.31 to 533.88. Volume spiked during the sell-off and then normalized during the rebound. Option chain snapshot playing the field. The options chain reveals real-time market activity strikes, open interest, bid-ask spreads, and volume. Volume stands at 100 or more, indicating moderate pricing, but can spike quickly. Strikes that have volume, like 170, 200, 205, and 210, attract the most open interest, showing where traders are focused. Tight bid-ask spreads mean strong liquidity. This is where strategy meets execution. High options interest marks battleground strikes, and volume tells you whether to learn or lean towards buying or selling premium. Strategy 1. Long calls and puts. Buying calls or puts offers the potential for large gains but comes with a low win rate due to time decay. These strategies work best during strong rapid moves, like SPY's recent drop or rebound. Backtesting shows about a 30% win rate, with most options expiring worthless unless significant moves occurs. During the drop to 481.80, a trader buys a $500 put for $8. As the SPY falls, the put's value surges, netting a $1,700 profit per contract. On the rebound, another trader sells a 530 put for $6 as the SPY climbs. SPY never falls back to 530, so the put expires worthless and the seller keeps the $600 premium. These examples show how aligning your strategy with market conditions, bearish during the drop, bullish or neutral during the rebound, can produce favorable outcomes. After SPY's sharp drop to 481.80, you anticipate a rebound. You buy a SPY 530 call expiring in 37 days. You see the option chain, and at the time the ask price was 54.10. SPY rallies to 570 by expiration, and your call is now worth over $40 intrinsic value, plus any remaining premium. If the SPY had stalled or dropped, the option could have expired worthless, showing the high risk, high reward nature of long calls. This is an example that shows buying calls can deliver big wins if your timing's perfect, but the risk of losing your entire premium is high if the option doesn't move as quickly. Strategy 2. Vertical spreads. Vertical spreads combine a long and a short option to reduce both cost and risk. Bull call spreads during rebounds and bear put spreads during drops outperform outright buys. Backtesting reveals a higher win rate, typically between 45 and 55%, with smoother returns and a defined risk reward. Expecting SPY to rise from 586.95 towards resistance at 595. You buy the 590 call at the ask, at the time was 40.08, and sell the 600 call at the bid, at the time that was 33.83, expiring in 37 days. Your net cost is $625. If the SPY closes at or above 600, your call spread is worth $10, netting $375 profit over the spread. If the SPY finishes below 590, your loss is limited to $625. Vertical spreads let you profit from moderate moves with less capital at risk and a higher probability of success than buying a naked call. Strategy 3. Iron condors in range trades. Iron condors and similar range trades profit when the price stays within a defined range, making them ideal after volatility strikes. They benefit from time decay and falling IV. Backtesting shows these strategies provide consistent small gains, but carry the risk of a large loss if the price breaks out of the expected range. After SPY's recovery to 586.95, you can expect consolidation between 570 and 600. You sell a 570 to 560 put spread and a 600 and 610 call spread, collecting about $3 in premium. If the SPY stays between 570 and 600 at expiration, you keep the $300 per condor. If the SPY breaks out, your maximum loss is capped at $700 per side. Iron condors are perfect for range-bound markets. They offer steady income, but you must manage risk if the SPY breaks out of your expected range. Selling premium, covered calls, cash secure puts. Selling options with protections such as covered calls and cash secure puts generates steady income, especially when IV is elevated. Covered calls cap your upside but reduce downside risk, while cash secure puts pay you to potentially buy shares at a discount. Backtesting shows that these strategies offer the most consistent and risk-adjusted returns. You own 100 shares of the SPY, bought during the dip at 500. With the SPY at 586, you can sell a 600 call expiring in 37 days, at the time the ask was 33.83, collecting $3,883. If the SPY stays below 600, you keep the premium. If the SPY raises above 600, your shares are called away at a profit, plus you keep the premium. Alternatively, you sell a cash secured put at 570 at the time the bid was 33.66. If the SPY stays above 570, you keep $3,366. If the SPY drops below 570, you buy a SPY at an effective price of $536.34. Covered calls and cash secured puts are excellent for generating income, especially in volatile or sideways markets. They work best when you're comfortable owning or selling the underlying stock. Case study: strategy performance and recent SPY volatility. During SPY's sharp drop, long puts and bear spreads delivered the strongest returns. As the market rebounded, bull call spreads, short puts, and covered calls performed best. Once SPY entered a consolidation phase, iron condors and range trades became top performers. Successful options trading is about flexibility and discipline, and continuous learning. Use backtesting to validate your ideas, adjust your strategy as the market shifts, and always prioritize risk management. Takeaways: best practices. There's no single strategy that works in all market environments. Adapt your approach based on volatility and trend. And always backtest before trading live to understand your probabilities and risk. Monitoring volume and market context is essential for optimal strategy selection. Risk management through position sizing, stop losses, and diversification is non-negotiable for long-term success. Successful option trading is about flexibility, discipline, and continuous learning. Use backtesting to validate your ideas, adjust your strategy as the market shifts, and always prioritize risk management. Thanks again for watching.